Here are some hidden tax traps that you should be aware of if you're preparing to exit your business. We will be discussing this over the next 4 weeks. What are some things to consider from a tax standpoint if you are looking to sell your business? Number one of the hidden tax traps with business exits is the asset allocation trap. So if you are entering into an asset sale of your business, the IRS requires that some tangible assets as well as intangible assets be accounted for in the purchase price. So what that means is some things like equipment and inventory may be taxed at ordinary income tax rates instead of capital gains tax rates in the eyes of the IRS. So make sure that you are allocating certain items appropriately so that you do not see a higher tax bill. Number two is depreciation recapture. So bonus depreciation can be a great thing when you're out purchasing a building for your business or vehicles. This can be a great tax deduction while you own them. However, if you sell too quickly after purchasing such items, you may have to recapture all of those tax benefits that you got, and this would get added to your taxes at the ordinary income tax rate. So if you're preparing for a business exit, make sure you're aware of what you've been depreciating over the years, because you may be looking at recapture taxes on those items. And number three is earnout payments. So earnout payments are a great way to potentially spread out the purchase price of your business and some of the earnings that you're seeing from the sale. However, when you pass these on to later years, be aware that these earnout payments will be taxed as ordinary income tax rates. So instead of potentially seeing a lower tax on that amount, maybe the capital gains rate, instead with earnout payments, these will be taxed later on at ordinary income tax rates. So those are 3 items that I wanted to touch base with you on today. Stay tuned as we will be going over some other hidden tax traps of business exits over the next few weeks.